Hello traders, Gary Wagner here just after 11 o'clock in Honolulu, 5 o'clock in New York. It is Friday. Happy Aloha Friday as we say on the islands, April 28th, 2017, and this is the Daily Report for Gold and Silver, our weekend review, and we've seen quite an interesting week indeed. Gold closed lower on the week and higher on the day, but it's first quarter performance that we'll really want to focus on once we begin to pull up our charts. As we look at gold, gold did close higher as we look at most active futures, up about $3.60 at $12.6950. It traded to a low of a 64.20 and a high today of 69.90. So we closed just shy of that high. Over to spot. Spot gold closed at $12.6791, a net change of positive $4 on the day. Silver did have a tough time this week, including today, closing 11 cents lower on the day at $17.22, the low $17.18 with a high of $17.44, and then over to spot silver, $17.18 again, down about 8 cents on the day. So traders, absolutely an interesting week. Now, even though we did close higher on the day, up about $3.60, the chart that we're looking at is most active June futures contract. We did close marginally lower on the week. You can see that expressed in this red candle right here. That is our weekly candle. That, of course, follows last week's attempt to break above 1300. However, that attempt obviously led to failure. No cigar there. We certainly saw this market move down. Now, when we look at these three candles in combination, however, the last 3 weeks, it does give us a variation off of a three-river evening star. And the reason that I'm saying a variation rather than a three-river evening star, it really comes down to the body size of this candle. And the fact of the matter is the body size is relatively small. And so for it to really be a three-river evening star in its context, you need to have a red candle that would look something like this. Then, of course, we would look to see if we got a confirming candle or a lower market move on the following week. And that, of course, would give you on a weekly basis or a long-term basis really a sell signal. Now, realize that this particular pattern can be quite accurate in depicting tops and bottoms. For example, here you see a three-river morning star. You get your confirming candle the next week, and that was really the beginning of a market move, taking us from the yearly lows at around, 1120 that started at the end of last year, moving up to 1264, finding some sort of a top. And 1264, traders, that to me is a critical number. Let's go ahead and erase the candle mark on there, because that is what I believe we are looking at in terms of very, very strong support in the market. 1264, if I draw a line straight across, we'll see that the market did dip into this area, but managed to close well above it, closing at 69. It is for that reason that I believe we could see next week a move to higher pricing and really void out any potential of this particular pattern carrying some weight. Obviously, it's something that we will have to see, but nonetheless, that is how we're reading our weekly candlesticks. And traders, when we convert our weekly chart into a daily chart, really what we see is a slow, methodical move from the highs that were achieved last week. Unsuccessful takeout of 1300, in which the market has come down and found support. And the reason we can see on a technical basis such a strong area of support, let me go ahead and draw this red line, try to keep it pretty thin, is that first of all, it does match roughly with a fib retracement area. I've got a couple of different fib retracements. When we look at these different retracement points, we do get a harmonics, and this is what I'm talking about. I've just adjusted our fib retracement. The first one is an extremely long fib retracement beginning at 1124. That is the low that, of course, was achieved end of last year, beginning of this year, up to these tops, the high this year at 1296. The second level starts after the market hit these highs at 1260 in that area. The area we're looking at came down and found support at 1200. So we're drawing this from 1195 up to the top. Now, when we do that in terms of our long fib retracement at 1256, you can see that we have a fib retracement of 23%, and that's based on this longer term fib retracement. When we look at the shorter term fib retracement, we get 1257, and that is a 38% retracement. And therefore, when we look at this particular area up until that top at 61, that is going to be a critical level that this market must hold if it's going to continue in a bullish trend. And to this point, there is only one way to look at the overall activity of this year, and that is that we are in a run, a bull run. How do I say that, and why do I say that? First of all, we started the year at 1120. Market hits a high at 1256. When it comes down, it hits a new low. This low is higher than the previous low. Then the market goes back into rally mode, trades as high as 1296 right in here. So therefore, this high is higher than the former high. So when you get a series of higher highs and higher lows, there's really only one way to look at that market, and that is that we are in a bull run or a bullish rally mode. We'd have to see lower highs and lower lows to believe that we were in a bearish scenario. But for right now, this market to me, overall, long term, is absolutely still bullish. Also, on a technical basis, there's another indicator that really shows us that gold is poised in a bullish manner. What we've done is we've added two basic moving averages. We have our long-term moving average, our 200-day moving average in red, and our shorter-term 50-day moving average in blue. We have been talking over the last week, almost on a daily basis, that it does appear as though our short-term moving average, the 50-day, is getting ready to cross above our longer-term red 200-day moving average, and that, of course, is called a golden cross. A golden cross is an extremely bullish sentiment. You can see here, this is what's called a dead cross, a point in time in which the short-term 50-day moves below that, and that certainly indicated some tremendous downside activity. But as this market has been moving up ever so slowly, we have seen this 50-day moving average really move closer and closer towards that 200-day. If it does cross, we label that a golden cross, and it's yet another technical indicator confirming the bullish sentiment in gold right now. So traders, the same cannot be said for silver. First off, we are looking at a basic daily silver chart also containing a 50 and 200-day moving average. What we see when we pull this up is that both of them have basically turned down, and although as silver was moving up, we saw the 50-day getting closer to the 200-day moving average, we now have them really both cycling down. And that's because over the last couple of weeks, we have seen extreme selling enter the market after silver hit these highs up above 1850 and have now given up roughly $1 to $1.25 in value. The other thing that we look at, to me, that really bodes that we'll see a continuation of downside or bearish movement, I've got a simple retracement from 1567 up to these tops, and when I do that, you can see that price point in terms of today's low falls precisely at a 50% retracement of this year's move. Simply put, this silver prices have given up about half of the gains so far this year. And then lastly, when we convert that daily chart into a weekly chart, it's quite evident that what we have seen this week is an engulfing bearish confirmation. We identified the engulfing bearish last week as we had this defined down week in which the market opened above the prior trading week and then closed below it. But this week we certainly have that confirming candle, and that confirming candle is a red candle with a lower low and a lower high. So on a long-term basis, it does appear as though we could see further weakness in silver pricing based upon the candlestick patterns that we have identified and the fact that when we look at our 28-week moving average, we closed below this particular price point. If the market does continue to track under pressure next week, I do not see any support in the market on a technical basis till about $17. In other markets that we follow, we had a milestone reached earlier this week when the NASDAQ actually closed above 6,000 for the first time in history. And the Dow, although it closed lower on the day, 20,940, had its best performance week this year, the year of 2017, closing at 90,940. S&Ps also trading nominally lower on the day, closing at 2384. And then, of course, the NASDAQ, which closed unchanged today, did close at 6,047. Absolutely taking out that milestone and then trading above it consistently for the remainder of the week. So traders, the last set of charts that I want to look at on today's weekend review are quite impressive, to say the least. We are looking at a monthly line chart of the NASDAQ composite. And this incorporates the entire history from the initiation of the NASDAQ back in the mid-70s through the extreme move to the upside during the tech boom. Here is our tech bubble that comes in 2000, really taking a tremendous amount of value out of the NASDAQ. The first attempt to stage some sort of recovery as it came up. And then, of course, 2008, the financial crisis hits right here. It takes the market down. And since 2008, we have seen an exponential growth in the NASDAQ composite. This week closing at a historical milestone, which put it above 6,000. There are really two real milestones. We've got the first milestone that comes in before the tech bubble, and then we have a secondary milestone in which it comes and breaks back above this. It took two real tries to do that, and of course this move that we witnessed this week. It is quite historic indeed. And of course, with that in mind, I've just pulled up a weekly chart, this in candlestick format, of the NASDAQ composite. We can really see the market move as it really broke in the financial crisis back in 2008. And then, of course, traded dramatically lower. And then this historical climb that occurred over the last really 6 to 7 years. And what is most impressive is this most recent move above 6,000. And to do that, we really want to blow this chart up and expand it a little bit, because what you'll see is this: as this market tracked higher along with the Dow Jones and the Standard & Poor's, it topped out really from the beginning of this year. You can see this is the onset of 2017. The market moves up and then it tops out for about a month and a half. But look at this severe jump above current resistance and taking out 6,000 with a vengeance this week and closing impressively above that price point. The NASDAQ, I believe, will outperform the other sectors in U.S. equities throughout the remainder of this year. That is my particular take on the market. So traders, when we look at first quarter performance of gold in its totality, it had a most respectable gain, gaining almost 10% from January through the end of April this year. However, when we take a closer look, what it reveals is that the vast majority of that gain came in January and February of this year, with last month actually closing nominally unchanged and about a 1% gain this year in gold, or this month, in gold. The key is this: we broke above a critical level of resistance over the last short term, and that was 1261. However, as the market moved to higher ground, it stalled at about 1297. And so we have some real resistance at 1297, some very, very strong support at 1261. We are certainly building a base in this area, and my sense is that we will move higher off of this base and break above 1300, with my top projection right now at about 1347. However, all bets are off if we get any kind of a move below 1261 on a closing basis. This has been Gary Wagner wishing you, as always, good trading. We'll talk to you next week for another daily update and review. Bye-bye.